Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, May 1st, 2020. We're going to start out here taking a look at the longer term charts. In fact, the longest time frame I'll usually work off of, which are the monthly charts. What that means is every candlestick here represents 1 month of trading action in the S&P 500. We're going back. We can roll back as long as we want into the 70s, but what we're going to do is, look at modern history, and there's quite a bit I'm going to cover here on this, looking at different boards. Well, the first of which is one of what I believe to be one of the most simple yet effective trend indicators, and again, a long-term trend indicator. Keep that in mind when we're looking at monthly charts and we're spanning decades, not a 60-minute chart that spans just a few weeks or a couple months. This paints the bigger picture, and probably the most important takeaway on that when analyzing these long-term charts is the bullish and bearish developments that build on the chart, such as divergences, such as trend lines that are forming and with prices walking up or down a trend line, and different trend indicators. They can take quite a bit of time, in fact years to build, talking about trend lines that build up during bull markets and bear markets. And but then when they do finally play out, when you get the triggers, they're usually indicating major trend reversals, in other words bull and bear markets, or significant corrections and rallies that can last months or even years in most cases. So that's the takeaway, is that they're not used as exact timing indicators. In other words, for active traders, it really does good to get in and out. But this is the it helps paint the picture for those active traders, helps you tell where you are in the cycle, whether the current trend is bullish or bearish, if you're coming up to resistance, where you're likely to reverse. And of course, it's great for 401k traders, investors, longer term traders, I should say, or investors, by helping to identify the primary trend and then position, try to capture the big moves in the market. Again, we're going back decades. You can see every bull and bear market that we've had, back into the 80s here. All right, so the one line we're looking at here is the 20-month exponential moving average. That's the blue dashed line. I've shared this many times in the past. Again, I consider it to be one of the most simple and yet effective trend indicators there are. So you give it extra points, in my opinion, for being so simple. Some trend indicators are pretty complex. You have multiple moving averages or other things you're looking at, different things that you have to kind of put together and check to confirm. But you can see what I'm referring to is like any time frame you're viewing, what's important is how you close at the end of that time period. So you'll see here there's some candlesticks that move down through that 20-month over time, but usually you'll close, if you're in a bull trend, you'll close a month back above that level. So that's most important. You want to look for a solid monthly break above or below, and a solid close, I should say, not intra-month, because you can get these intra-month dips right there like we've had back in 2015, 2016, only to see the S&P or whatever index you're tracking close back above there. And if you go back in time, what might appear at quick glance as whipsaw signals were not. These were bear markets. That was a bear market in '87 after Black Monday, the crash of Black Monday. In fact, you had a bear market in a single day. The Dow dropped 20 something odd percent in a single day back then. That was our last next bear market, early 90s, and so forth, so on. The big bear market that followed the dot-com bubble, the big bear market that followed the housing / credit bubble that topped in 2007 to the 2009 lows, and the one that we entered a couple months ago. They're all on there. And the thing is, so that's it. When the S&P 500 is trading above that line, you're in a bull market. And when you're trading below it, you're in a bear market, even if those bear markets are relatively short. Some last longer than others, just like some bull markets last a lot longer than other bulls. And of course, let's zoom in real tight here now and look at what happened last month. This was back in December, I'm sorry, the last quarter of 2018 back here, where we did have a whipsaw. We had one close below and then recovered it the very next month. So you can call that a whipsaw. You can call it what you want. By a lot of metrics, this is really when the markets broke down. We're going to get to some trend lines and some other things here in a second. So that is what technically at least by my analysis, started the bear. We just had a back test of those trend lines that were broken back then. That kind of triggered. But either way, we'll call that a whipsaw because we did go to new highs. And again, it got you back in the following month. It said, look, we regained that level and we stayed above it. And as it usually does, it acted as support since then until just recently. So just to bring us up to speed here. During the month, this candlestick right here, which closed the month of March, that put us down below it. This is April's candlestick here. We close, you're talking a hair above it, but statistically not enough to say that you've regained that level. Again, you got to give these things a little bit of room, and so you can see the 20-month was right there, and that's where the close was, less than 1% above. So that is essentially just a back test of the level from below after a solid close. In fact, when I say solid, we close, much further below that 20-month last month, all the way down here about over 10% below. We're back in 2018 in December. We closed down only about less than 5%, 4.5%. And so there it is, back test, and that's where we are today. So I just wanted to kind of go over that. And if and when the S&P 500 should move back up here, let's say in April we close back up here, somewhere up here, a solid close above, then that can't be construed as anything but bullish, at least from this one trend indicator. And this is, I always say, I don't use any one single indicator, a standalone buy and sell, be all end all, but you take it in context with other things, other indexes, things that are going on. But again, that could be construed as nothing but bullish if that is the case. So we'll watch, and we're not going to have an update until the end of the month now, because this is our May candle here. We're just starting out, so we've got a way to go, and we'll update that later at the end of this month. Okay, now we'll turn on some other layers here. We'll turn on some price, some trend lines and divergence lines and other things. And let's roll back here all the way again to the 80s. And you can see at a quick visual all the bull and bear markets in the past. And for the sake of this, I've marked up the bear market and the bull market trend lines. You can see they all have a lot in common, and that is the negative divergences. These are your divergence lines down here. Negative divergences that span, as I said, usually take a year or more, sometimes several years to build. And bear market, that was a bear market back and a recession back in the early 90s there. Then from that point, and we'll get to that in a second, we embarked on up until recently the greatest bull market in history right there. Big run, the longest I should say in history, that is. And that was then followed by, as you can see, pretty clean stuff here. You get these bull markets, you get the trend lines, and it's not mere coincidence when you get a trend line break. Usually that 20 EMA comes right in there, give or take within a month, sometimes the same month, quite often. And so it gives you a confirming sell signal. So as a minute ago I said, you don't want to use any one single indicator as okay, we're in a bull market, we're in a bear market. The more evidence you have, the better, and you can see that's the case. Usually you have these well-defined uptrend lines, and then the market breaks, and quite often back tests like it did here, and puts you in a bull. The next ends the bull market, starts the next bear market. Back here we had, this was a near bull. Should say a near bear. We went in what we call a deer market. A deer market is neither bull or bear. It's when the market trades sideways for an extended period of time, as it did back from 2014 to 2016. And even then, you can see the 20-month did a pretty good job of holding up there. So nobody won back then, bulls or bears. It was a consolidation period, and we went on. And it is, since we'd never had a closing drop of 20%. We just slightly averted that on the S&P 500. Some other small caps, mid caps, they dropped more than 20. So you can call that a bear, you can call it a bull, whatever you want. Most, for the records, they considered a continuation of the bull that started back in March 2009. And again, we're going to get to some other trend lines in a minute, but you can see right here, this is what I was talking about. In 2018, at the end of 2018, we had a breakdown of a well-defined primary uptrend line off the 2015 lows right there, and then we've been back testing it since. So that's what I was referring to. We also had a divergent high and all that other stuff, and we went on to make, when I say marginal new high, it's 14% marginal, and that's the other theme of what I'm trying to convey here on the monthly charts. Everything is relative. In other words, the corrections, the rallies, the primary trends are all relative to the scope or the size of the bull market that you're in. And For a while now, I've been referring to this. The term I assigned to this bull market, biggest in history, is supersized. That is, the condition from all the Fed money printing, and not just Fed, all the central banks around the world, injecting a tremendous amount of liquidity into the market starting back in 2008 and keeping the pedal on the metal throughout most of that. We're starting to try to pull some of that back in and take down raised interest rates some of the way up there, but they kept the gas on the pedal throughout this, and that's why you have such a huge bull market compared to those previous ones there. So just wanted to point out that that's where we're at. Breakdown back test, and below the 20-month, big divergent high. Typically, the bigger the divergence, the bigger the ensuing correction, as you can see in a lot of these, but not always. Back in 2007, it was relatively small divergent high, but that's all it took to give us that 55% bear market. Okay, we'll look at a couple of potential chart pattern formations besides those wedges that I've showed you on those other charts there a second ago. One of the things we'll continue to monitor, it has some work to be done. And you probably heard some about this, and probably will hear, almost certainly hear more about it, should the markets reverse from or at these levels. Now, it doesn't have to do it right away. I'll get to that in a second. But what we're looking at is a head and shoulders topping pattern. You have those consist of a left shoulder, a head there, and then a right shoulder. And again, the right shoulder right now, the symmetry on the pattern isn't very nice, what you want to see. They don't have to be perfectly symmetrical, but it's nice to see them somewhat symmetrical. In other words, we've had a quick bounce off the lows, so your right shoulder is forming, if that is what this is, that's why I have a question mark, a little faster than what you'd normally see. Again, to have symmetry on the pattern, you'd have something, I'll draw it out here along these lines, trying to get a trend line here, something like that, a left shoulder, head, and a right shoulder. And that still could happen. Let's just say the market trades around sideways for a while, maybe has another hiccup back there, goes up. That could put in that right shoulder. Now, it could put it in here. Again, you're not going to have perfect symmetry, but the most important thing is you do have a kickback right here at a point when you want to see that right shoulder, as long as it's not too much above the left shoulder. Remember, we have a downward sloping neckline. Sometimes on these head and shoulders patterns, you can have, a classic head and shoulders has a flat, no slope to the neckline. Some of these have an upward sloping neckline, but typically the downward sloping necklines like this are more bearish. They're the more bearish of the two, at least compared to the horizontal neckline. So that's it, just something to watch. And it's interesting because about symmetrical, at least in the distance between the head and the neckline to that left shoulder, we're right at that 20-month. So there's a lot of things pointing to the fact that to keep the longer term bearish outlook or scenario intact, you would need to see the market turn down from at or around these levels. And again, remember, everything's relative. This is a big move here, so a 35% drop followed by a 20-something odd percent rally. So we're not talking a 0.5% or 1 or 2%. We're talking within 5%, maybe 5% or so from the recent highs in the S&P. So again, just one of many things. And then on a head and shoulders pattern, to get the measured target, you take the distance between the head, the top of the head, and the neckline, and you add that to where it breaks down. So what I did here is just kind of a guesstimation, knowing that stocks tend to fall a lot faster than they rise. So should this develop, should we reverse now or even later on, it'll probably be a quick move down. And that's one thing you want to see too. You want to see impulsive selling and increased volume on the move down from the head and the move down from the right shoulder. That's where I think a lot of traders, because these are some of the most commonly recognized and used and talked about patterns out in the blogosphere, but I think a lot of traders fail to confirm them on volume. We certainly had big volume. I don't have my volume bars up here on the move down from the head, so that's something we want to watch for in the coming weeks to months here. Should we get an impulsive move down on increased volume, that would help to give an extra checkbox to the fact this may be a head and shoulders pattern forming, and then wherever it breaks down, we'll have to add that measured target. So what I have it down here is just assuming it breaks down around this point, that'd be about a 1340 target on the S&P 500. Let's zoom back. You can probably see some notes right here on this chart. Let's take it back. That was the last bull market right here. End of the last bull market, and that ended with a head and shoulders pattern. You can see right there. I'll draw it out for you. We had our left shoulder right there. Let's grab this trend line here. Left shoulder, head, right shoulder kickback rally, and neckline right here. And there was our measured target, which is almost exactly what we hit. Maybe we went a little bit below it, but then we came in and back tested the neckline from below, and that's common too. If you have a head and shoulders breakdown, whether or not you met your measured target, look for a back test of the neckline, because that was support. That was your sell signal to enter a short trade, and the measured target would have got you to cover around that point somewhere in there, and then on the back test that would have been another objective shorting entry, and you can see in hindsight that caught the bulk of the move, the big leg down in the bear market. Okay, one other potential pattern I pointed out in SPY recently is this megaphone pattern. Let me turn off all these lines and just draw it out for you another way. Megaphone pattern, aka broadening wedge pattern, is this. You have, well, that's it. A pattern that looks like a megaphone or a broadening wedge, and you have enough tags in there. You have your 3 distinct tags at the top, your 3 on the bottom here. And I mentioned just last week, I believe it was, a strategy called a partial rise. And a partial rise is when you have a fully mature broadening wedge pattern like this. You can short at one of the key fibs anywhere from the 38.2 up to the 61.8. We did that on GDX a few years back, and it marked the top in the gold mining stocks. We had a very nice short entry there, and it was an official trade as well at the time. And then gold mining stocks went on to do that. So, and the thing is, you put a stop. You don't want to go much above the 61.8 fib. And so it's a great risk-reward strategy. Just a little bit of an aggressive, what I like to call anticipatory trade. You're anticipating a reversal that hasn't yet come. But it's TA 101. You can either short rallies back into resistance, which in this case there's quite a bit here, including key fib levels, or you wait for a break of support. So that's one thing to watch there. And of course, ultimately, if we go on to break the pattern, see, the benefit of shorting, doing a partial rise, is you're getting a much better entry price. If you wait for that pattern, the broadening wedge or the neckline on that head and shoulders to break, well, guess what? S&P is going to have to drop about 27% to get there. So you're going to have a much more favorable price here, and then you can also allow for a larger, a smaller, tighter stop. So it's all about risk reward, and I think that's still a good time to be layering back into shorts. Okay, now let's talk Fibonacci's. These are Fibonacci retracement levels we're talking about here, and what I'm looking at is the move. We know that technically we entered bear market territory, but clearly this time around, so we're still going off that working thesis that we're still in a bear market, and this is one thing. Remember, again, the common theme here, everything is relative, and that's where I think a lot of people get lost. They get wrapped up in the media headlines. Biggest rally, April was the biggest monthly gain since 1987. Again, well, what was 1987? Well, that was a bear market. That was a Black Monday. Market crashed over 25% in a single day, and that's where circuit breakers were implemented after that. That they came in and said, "Whoa, well, we didn't realize the market could fall, over 25% in a single, or over 20% in a single day, and so we're going to have to do something about that." And that's where circuit breakers were implemented shortly after 1987. So, point being that the biggest rallies always come. Again, the biggest rallies always come in bear markets. Some biggest, stock market rallies, biggest monthly gains, all that kind of stuff. Go back 1929, check any period you want. So again, don't put too much into that. What's most important is, again, since everything is relative to the scope of the move that you're in the market, this is a much more powerful, or at least we're coming off a much more powerful bull market. So you're going to have bigger counter trend rallies. This was the biggest drop since 1929 back here, since the Great Depression. So again, that kind of jives with what I'm saying about everything being relative to the scope of the previous move, and so this rally should be very big, and this is the first bear market rally, should be big in percentage terms, which it was. However, it wasn't supersized or larger than normal in percentage retracements. This is where Fibonacci's come in. Missed it there, but that show you that line right there off the highs, the all-time highs in the S&P to the lows in March. We hit almost to the button, as I mentioned, the 61.8 Fibonacci retracement level, and that is a typical retracement for a counter trend rally in a larger trend, meaning the new trend being down. This is the first counter trend bounce, so if we go up much more, if we go over last week's highs, does it eliminate the the bearish scenario? No, but it starts to chip away at it a little bit. But again, there's a lot involved, more than just this. That's why I've spent 20 minutes so far talking about price levels, trend lines, trend indicators, things like that. So it all gets factored in. And right now, everything so far I'm pointing to is saying bear market rally. Let's go back here. So, okay, I showed you we went to the 61.8. Let's zoom back to the last bear market and see what happened on the first bear market rally. All right, we're going to zoom in nice and tight. This point right here is the highs. It was in October of 2007 when the previous bull market ended back then, and that went all the way down to March 2009. However, everything works in waves. Nothing goes straight up or straight down. You have these waves in the market. So I measured these purple lines. I got rid of all the other fib levels except the two that are relevant here. So there was our top right there. This was the bottom of the first, right here, this candle, the first wave down in that bear. See all those 1, 2, 3, 4, 5 monthly red candles. So we dropped for 5 straight months. Well, really topped in October, followed by 5 consecutive months. So there's 6 months down. That one played out a little slower back then. Then we bounced right there up to that top, and you can see the lines. This is the 61.8, that purple line there. Hopefully you can see it on the YouTube videos. These are your fibs right here, and this is a 50. So we really went right about between the 50, right about in the middle between the 50 and 61.8. So again, typical bear market stuff, followed by at that point from there, that's where the bear market rally ended, and then we dropped another 54% from that point. And I'm going to get to how much that rally was in percentage terms in a second, but before we do that, let's just roll back one more bear market. We're not going to do each and every one. You're going to see almost the same thing all the time. We can go back as far as we want. There was the highs. This was the what we call the dot-com bubble back then. That's where that market in the early 90s into 2000 ended. March of 2000 was the high, and what happened is we had the first leg down. It was a pretty good one, about 30%. So comparable to this one. Remember, this bull market, by the way, the one preceding the top in 2000, was much, much more similar. In fact, it's probably the closest bull market we have in both duration and scope. In other words, how long it lasted and how high it went to this current one. And there it is. You can see I have the fibs up. It's just the yellow line here. I got rid of everything else, and we hit to the button. Let me zoom in real tight for you. And show you what I'm looking at here. We hit a 50% retracement. So we went from the highs right here. We had an initial leg down, kick back on the button, hit the 50% fib retracement, and then we had from that point, and look what we also hit right at that 20-month exponential moving average. Like I said, it's just done a great job over time. 42% drop from that point. And I can tell you, because I'm trading up bull markets, people were just as bullish as they were yesterday or the day before when the market had been rallying. It's human nature. You have a rally that goes. Let's see, that rally back then, I'm going to measure it out here in another chart too. That was a 21% rally. That's usually what it does, especially on the heels of a bull market, because they're used to buying these dips. So when you go 21%, it's, for years, it was the beginning of the path to new highs. And so should this be what we're in now, a bear market rally, again, that's what it should feel like. And I said it would before when we were still on the way down a couple months ago. I said, wait till the first bear market rally. It's coming. And you will see how bullish it feels, how bullish the news headlines will flow. That is one promise I made as well, that the headlines ebb and flow with market conditions. They start getting rosier and better the more the rally goes, and then all of a sudden you start going down, take a little while, and then the headlines will start to get a little more doom and gloomy, and then the next wave begins. So that's it. And there's those levels. Now let's look at one more. Same thing, we're still in a monthly chart here, I just have different boards. And this one again shows you, you can see all the bull and bear markets going back for decades, all the divergent highs that played out. And I just want to measure them. So back then, okay, this was Black Monday, that was a single day, but there was a monthly candle, huge drop. That was 36% drop off the highs. This was a bear market. We dropped just over 20% on a closing basis, and that coincided with a recession in the early 90s. So this from here to here, that was, up until that point in time, the longest bull market in history. It lasted 9.4 years, and from the low, from beginning to end, the market gained 427%. So pretty impressive. And the next bull market started, I should say, back in March 2000, right here. Here, let me mark it up for you. And right there, I'm sorry, not March. This is 2002. It lasted 5 years into the highs in October of 2007 and was good for 101%. So you can see, like I said, we'll call it a little baby bull market, but still 100% by most, up until this one came along, by most metrics, that was a healthy bull market. But what I'm trying to go with this is show you that the first counter trend rally after the highs here, we had our first counter trend rally, those that I just showed you a minute ago with the fibs. That one was 22%. The one with the bear market that started back in 2000, 22% on the initial bear market rally. This one, because we had a smaller bull, and therefore your Fibonacci retracements, everything is going to be a little smaller. We had a smaller, initial leg down with a 16% kickback rally. And then this time around, just again to put it in perspective, trying to compare it to this one, remember 22% rally. This time around we had a 35% rally. So as far as the rallies go, bigger the bull leading up to it, usually the bigger the kickback rally you're going to get. So that's it on the long-term charts. Let me see if I have anything else to show you. I can take it down a notch to the weekly chart. So now every candlestick's a weekly, and we'll just look at since the last bull market and some of the technicals on the weekly. So I showed you already the divergences on the monthly. I shared my thoughts here back in the that major drop back in late 2018, the last quarter. That's really where I saw a lot of trend lines break. I had this primary bull market trend line here that broke, and as I said, was back tested since then. So that was really a breakdown that I called it back then the shot across the bow, and we back tested. Sometimes when you have a trend line break, that's it. You never look back, and your next corrective wave or bear market starts, and sometimes you go on to back test before the move starts, and that's what we did. And yeah, you might say, wow, that was that bottomed in December. It was Christmas Eve 2018, and it took 1.2 years. Well, yeah, again, it's the scope of this bull market. Remember, this bull market was almost almost 12 years old when that happened. So it's in the scope of the bigger picture, it was really it fits with just a breakdown and backtest, what I'm trying to say. And then this is a benefit of the doubt or secondary trend line we have here. You can see it. I don't know if you can see it goes all the way back and it catches the 2009 lows. Let me draw it out for you. And that one's been taken out as well. So I'm spending time here on the S&P 500 because that is the stock market. This is more representative of the economy than the NASDAQ 100, which is really not a well-diversified index, and it's overweighted, has too large a weighting to the top components to really be indicative of the economy. Apple, Facebook, Amazon, Microsoft, great companies, but they don't employ a majority of the world's employees. They're tech-based companies, and again, they're not representative of the overall economy. The S&P 500 is, and more representative of the stock market. So that's it. And then on here, what I see is I like to use the 40-week moving average, 40-period weekly moving average on the weekly chart. That's the same as your 200-day exponential moving average on a daily chart, and it's a pretty key level. And you can see, I've talked about it many times in the past. Look where the S&P 500 kissed that level this week and had a reversal, put in that little doji type candle right there. So far, pretty much the market's stopping where it should stop. if this is a bear market rally. Again, there's a little more upside if it wants to go up there and back test that trend line, and maybe come up and hit the next higher fib level. But that's where we're at now. Step down in time again, go to a daily time frame. Here's SPY. There's a trend line off the lows. That's a major reaction low in March on March 23rd. Formed this bearish rising wedge right up to this 295 resistance level here, and boom, pretty impulsive breakdown right now. Again, you can't see it because I have it turned down, but failure right at that 200-day exponential moving average. Some traders like to prefer to watch the 200-day simple moving average, and for that reason I'll keep it on my chart. That's just a little bit above. Should should the S&P manage to go higher. Down below you have the 50-day right there, and 20-day coming in just below as well. So we're kind of playing ping pong here between some of the shorter term, faster moving averages that we've regained and some of the longer term. Now on the as far as a bear market rally, I put a much heavier weighting on the long-term moving averages, like these 200 days. That's what usually, and you can go back in time too and see at previous bear markets, that's normally where the first bear market rallies were capped, and even subsequent bear market rallies. And then finally at some point when you take those out, the bear market's over and a new bull market started. So like I said, much higher weighting on these longer term moving averages than the shorter ones. They're a little whippier, but they are worth noting. And so if we go much lower than where we hit today at the lows, we're going to take out the 50, and that'll probably bring in additional sell orders. So that's a level to watch next week. And then just below it, you probably can't see it there in purple, I have the 20 EMA as well. Other things to watch for in the coming week or so would be a potential high-level bearish PPO crossover, clean separation. I've talked about that before. I went over that in recent videos. That's something to watch. We don't have it yet. Let's look at the Qs, because they are certainly worth watching and worth mentioning. QQQ. There's our trend line, the purple trend line. I was really highlighting that on the 60-minute chart here. That was taken out as I updated today, and we really hit and parked on that 211.96 level, and that's where we ended the day and ended the week. So we'll have to see how that picks up next week. Those are levels to watch. Keep it kind of simple. Should we move much below today's lows impulsively, that will take out some of those key support levels, open the door to the next leg down. Should we go back up? Well, you still have, as I mentioned today, you have today's gap right here, that horizontal line, that should act as resistance, quote unquote. If it doesn't, we go up through there, well, then that would open the door for a run at the previous highs and or back test of the trend line. There's still some significant resistance levels above. But the ideal bear scenario, especially with today's breakdowns being pretty impulsive, would be to see more follow through next week. SPY is back down below that suggested stop of a daily close above 286.08, so still an active trade. And you can see kind of did the same thing. It danced on. I had that 281.48 support on that chart before we even went into today. We hit it and traded 1, 2, 3, 4, almost all the candles. Well, this is after hours here, but pretty much since we hit it, this is what I refer to as a reaction. So either a bounce or a consolidation, and that's a consolidation right there. So to be continued next week. Again, that's the after hours candle. Don't just ignore that long skinny part there. That's an erroneous print. Sometimes it just seems to get these prints that go up to the previous day's close, whether or not somebody traded there or not. But that's it. So we'll pick up next week. Bearish, should we go much below today's lows? Near term bearish, opening the door to the next move down. Near term bullish if we pop up with a gap to contend with, which is right around our stop, and I talked about that earlier today. I'll just have to make a decision next week on Monday, if and when we get up around there towards the close, whether to pull the stop one more day. Hopefully that won't need to be done. I think we'll just, at this point, since we had some pretty solid sell signals today, I think we'll continue down next week. We'll wrap it up here, guys. This has been Randy Finney with Right Side of the Chart. Have a great weekend.